Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 30 minutes here. It is Friday, March 8th, 2024. The markets are open and rocking and rolling. Great week that we had in the S&P 500 index. We had some jobs numbers today, and the numbers were average. There's nothing wrong with what we saw, but the revisions were a big deal. There were quite a few revisions on the number of jobs that were created in previous months. And because of that, the market has taken this soft landing version of the economy as, one step forward. So this combined with Jay Powell's comments this week looks like it just set the market up for a rally, including in the IWM, the Russell 2000 index. The chances of a rate cut have increased if you look at the futures, absent Jay Powell's comments. And because of that, the market is just real strong. There's really nothing to try to drive the market lower except Apple. Apple is struggling a little bit, and so is Google. And Apple had the big news about being fined by the EU for anti-competitive practices, and they're throwing out a real big number, and Apple is struggling with it a little bit. And the stock, and it's just great to see the actual marketplace be able to set all-time highs actually in the SPX and et cetera. Without Apple, and that doesn't happen very often. Also, Google has been struggling a little bit. So our NVIDIA position that we have in our paper trading portfolio has gone to the moon. The portfolio has done extremely well. There's only one stock that I'm actually kind of surprised. I didn't quite remember when we bought the deep in the money call option, but we have one stock that's actually down in the portfolio now, and that is Google. So Google needs to step up their AI game, is what the marketplace is saying. The founders at Google are kind of arguing a little bit with this, saying that they are making headways, but the marketplace isn't believing it. Market is down. They're still having strong earnings, but there's a lot of concern about their hold that they have on search. And if they don't start being leaders in the AI space, that they might lose that hold that they have on it. So the market is down a little bit on Google. Now, so we're going to actually start this week by looking at that paper trading portfolio. Now, inside the TradeHawk software, I don't want to go there just yet, but inside the TradeHawk software, on the paper trading side of things, you can't get quotes in the SPX, but we do have our portfolio, and we are maintaining that portfolio inside the TradeHawk software, which is really nice. We can actually place trades and we'll execute them. And we did this with our deep in the money call position. We decided we were going to do this at the end of the year. We decided to get long in November on a few of the underlying stocks. And one of those stocks, luckily, was NVIDIA. Obviously, like the semiconductor marketplace, no idea that the stock was going to skyrocket like it has. It's gone perpendicular as far as the chart is concerned. A lot of good news in that stock this week to go along with solid earnings. Around earnings, the market seems to have a tendency to sell off. And I say that, trepidatiously, in that usually after the earnings, they still get a spike because they're just blowing the numbers out of the water. The marketplace wants to sell it off after earnings on NVIDIA, but it just can't because the earnings are so good that it takes a few days to play out before the sellers eventually come in and they get a little bit of a drop. And that's been the pattern with NVIDIA. Now the stock is just rocking and rolling. Large numbers don't matter. There was some mention of a potential stock split. Now that's just pure speculation, only because the stock is now trading at $936, up another $9 today, or almost 1% on the market, which it just doesn't seem to go down. It's a really amazing stock, and hence the reason why Google is struggling a little bit. They just haven't secure, and Google's not very good at they're not very good after earnings on how they sell themselves. They're very secretive across the board. Forever, you never even knew what was going on with YouTube and that part of the company, which is just exploding. They get so much free content. It's crazy, and they just have the views. And so going along with Google, it's the best priced of the Magnificent Seven. Google and Tesla is actually kind of hurting it a little bit too inside the Magnificent Seven. But with that mentioned, I'm going to start by showing the paper trade portfolio. So let me get that up first here. And we're going to adjust a couple of positions in the paper trade portfolio. And then I'm going to talk a little bit about the paper trades that we did this week in the SPX. And that's how we're going to finish it off. And I think we're going to move our outlook to be a little bit more bullish going into next week. So let's pull up the paper trade portfolio. Here we have it. So let's show the paper trade portfolio right now.
Brian, you haven't shared your screen. Sorry.
Oh my gosh. There you go. Problem solved. So we have the paper trade portfolio up right now, and we're showing, first of all, NVIDIA. We actually have taken some profits off the table. Going into earnings, it was such a big part of our portfolio. The last earnings report, we decided that we were going to sell one of the 3 call options. On the 2 remaining call options, the position is up 291%. That profit and loss just on that position by itself is $99,000. Now, to start with on our paper trade portfolio, we had a $200,000 portfolio of stocks. And the concept was, instead of taking the $200,000, all 100% of it, and putting it into the stock market on individual stocks, maybe these stocks that we chose, we decided we're just going to buy deep in the money calls and only spend half of it. So we had half of the portfolio invested, and that obviously protects the second half. We have limited and known downside risk, but we still have option contracts, and we still were paying a lot of time premium because we went deep in the money. If you notice, the days to expiration, the DTE, is over 300 days still. So we went way deep in the money. And in NVIDIA, the stock, the option contracts have done extremely well. Our cost was $170. They were very expensive, and there's still a lot of juice in it. And we were able to actually sell a call that expired. We sold the 850 calls that expired before that rally. So we did bring in some premium above and beyond. This is just a screenshot, so I can't show you the activity of what happened. We also sold one in Charles Schwab. We sold a call option. Schwab, the market with the New York Community Bank and the struggles that they had, it brought all the financials down a little bit. With interest rates moving, though, you still want to be long some financials. I still think it's an important part of a portfolio. We're looking at little stocks. I actually don't even mind buying something in the XLF, which is an ETF that tracks the financials. I think Schwab is one of the good stocks in the financial area, and that they made some real strong moves in the brokerage industry. They were the ones that took commissions down to 0. They knew what they were doing. Once that happened, they bought TD Ameritrade almost instantly. They knew that TD Ameritrade was going to struggle with their assets when they went to 0 commissions. And so they came out and got some stock, some big companies on the cheap, and the company is rocking and rolling. They're right now pushing forward by doing the transfer of all the TD Ameritrade accounts. And so far the news has been good on that side, because just because they bought the company doesn't guarantee that the people are going to transfer their accounts over. But that is where they're at, and things are very strong for Charles Schwab. So out of the financials, this is the one that I think I like the most, but I like the financials in general. The smaller community banks, regional banks, that there's still there's a perceived risk, seems to be isolated only to the one big company that actually was able to go and do a round of funding. So New York Community Bank that has been able to get some capital to be able to try to kick the can down the road or just keep the company up and rolling. Who knows? Maybe they'll pull it out. But that's what brought down the financials at that point in time. So today, out of these stocks that are in the paper trading portfolio, NVIDIA, not going to mess with calls. Now, we sold a call option after they announced earnings because, once again, we had a little bit of a sell-off after the initial run-up because the earnings were so good. And we got out just luckily at we did a short-term option contract, and that actually expired on a little bit of a downturn in NVIDIA. So we're going to stick on Google and we're going to stick on Schwab. Now, look at this. And I say it surprisingly, but we actually have one of our option positions that's down, and it is Google. It was a $40 option contract. We bought 4 of them, mainly because we could buy more, right? We were trying to put those funds amongst all of these option contracts. And Google being where it was and with its implied volatility, the 80 delta option with that expiration date was the cheapest out of all of these underlyings. Eli Lilly actually had a really good week also, and that stock is pushing up against all-time highs. And in the retail space, Home Depot is doing really well too. So is Lowe's. Lowe's has had a good run up and a good earnings season to go along with it. So we're going to sell one of these in Google, and I'm going to have to do it in the actual portfolio. This won't be in the paper trading app because we're going to talk about the SPX, and I can't get quotes in the paper trading app for the SPX, and it's mainly because quotes cost money in some of those indexes. So on the paper trading portfolio, some of those indexes you cannot get quotes in. So I'm going to log into the real market. We're going to look at what we would sell in Google. I'm going to look at what we would sell in Schwab. We're going to leave these positions alone at this point in time. You might sell one in Home Depot, but I don't think I want to mess with it at this point in time. The market is strong in Home Depot and in retail. The consumer has just been really resilient. We got the jobs data. Wages are still looking strong. It was, I think, a Goldilocks scenario with the jobs news, in that there was some bad in all the revisions that happened, but there was still good. We're still under 4% unemployment, which it's the longest stretch since the 60s that we've been able to maintain unemployment below 4%. So that's obviously good news, but it also upticked a little bit. So as far as the Fed is concerned, that is good news on their end, showing that the economy is slowing a little bit. Okay, so here we go. Let's zoom back out for a second. And we're going to run over to the TradeHawk software. This time it's going to happen. Okay. All right, let's put that in. Let's take a peek at the SPX and the TradeHawk software. So let's start by looking at Google. And the underlying that we bought in was Google. You can also do Goog. They're 2 different stocks. Don't want to get into that can of worms, why there are 2 symbols, but it had to do with their stock split. So with that said, 137.77. We always want to err on doing less time as opposed to more, which helped us out in the NVIDIA trade. So we have lower implied volatilities. Let's go here, 26% is about the implied volatility, a lot lower than NVIDIA. So we might have to go a little bit further out just because we're not getting as much juice, obviously, for obvious reasons. And so we'll look at a 14-day option, but we'll probably settle for a 20-day option. So the March 22nd expiration, let's go out to the 1 standard deviation move, which is inside the option grid, and the options grids highlights where a 1 standard deviation move is at, which is 145 here. We have the delta right around between 16 and 19, and that's kind of giving us a hint towards the probabilities. So we can get 65 cents for the 146 option contract, And that's where I'd be looking to go, at least the 146. Don't mind that contract. Now let's run out to the March 28th expiration, and let's see what we're getting for that. 65 cents, maybe 70 something, 79 if we click on that. Oh, what's that, the 146? 146. Oh, yeah, we're going to get a little bit more if we do the 146. So we're looking at 94. Now that's a little bit further, a little bit closer in the money. You're looking at a 20 delta. So the 147 is probably what we would look at. Yeah, I don't mind that. Let's do the 147, bringing in 79 cents, going out 20 days. So we go up 1 point, and we're still within the one. We're still outside of the one standard deviation move, which means if you hold it to expiration, there's going to be about a 17% chance of this option contract finishing 1 cent in the money. That's what this is implying. That also adds, though, if you look at the probability of it touching, of it getting to that number, that's almost usually about double on these out of the money options, right in this range. So you're looking at 34% probability that it could get up and maybe touch that range. Now, these are theoretical numbers, but just want to be, a lot of people look at the probability of it expiring at above that strike, and expiration is much different than the probability of touching at any point towards that expiration date. So even though we have a high probability that it will expire if you rode it all the way through ups and downs and whatever, but the probability of it actually coming up towards that range is around 34%, somewhere close to that. So this is the one we're going to sell. So I'm going to click on this, and this will be the number of contracts that we had was 4. We'll sell 4 of them. Just because we can, and we're looking in a paper trading portfolio. So we're going to go out to the March 28th expiration. I'm going to go back over into the paper trading portfolio, and we are going to sell 4 of these contracts. And we're going to do this at a limit price. We'll say 78. We'll go 79. Let's make it 80. Then the math's very easy. Now, in the paper trading portfolio, no guarantee we're going to get 80 cents, especially in that execution. But this is what we're going to say happened. Okay. So I'm going to take a screenshot of this. I'm going to go put this into the paper trading portfolio. As soon as we're done, we're selling 4 of the Google March 28th 147 call options at a limit price of 80 cents. And the days to expiration is going to be 20 days. All right. That's the position that we have on. Then let's look at what we'll do in Charles Schwab. So that's Google. I'm going to write that down just make a note of the 147 and the 328. Now on Schwab, we'll do the same thing. We'll look at the nearer term expiration, and then we will look at the one expiration out. So let's start on the 14 days. On the 14 days expiration, the one standard deviation move is somewhere between 72 and 73. Big difference in delta between the two of those two. We're only getting 21 cents on the 73, and we're getting 34 on the 72, looking at a 28% implied volatility. But now, in this instance, the difference is the actual cost of the underlying stock. In this instance, we have a $68 stock as opposed to a $137 stock. And the implied volatilities are very similar, but Schwab is cut in half as far as the price is concerned. And that shows you how much price has an influence on the premium that you can receive for your option contracts. So it's that simple. They're priced as insurance products. And if you think of insurance products, it's going to cost you more to insure a Volvo than it is going to insure a Ford Taurus, right? The more expensive the underlying car is, the more expensive the insurance will be. And if you think of options in that way, that's how the underlying stock, that's how it applies. So let's look at the March 28th expiration. And now we're getting 34 cents, 22% implied volatility. Okay, so it looks like we're going to do the 73. And I think we have 3 of those contracts in, I guess I could look real quick. We have 3 of the Schwab contracts. So in this portfolio, we're going to sell. Let's hit the bid here. Wrong option. 1, 2, 3. Okay. We are going to sell 3 of the Charles Schwab March 28th expiration 73 strike calls at a limit price of 36 cents, good for the day. And we'll send that in the paper trading portfolio and hopefully get filled. All right. So if you have any questions on how we're managing the paper trade portfolio of the deep into money calls, feel free to put them in, and we will try to address them during the show. And if not, let's go and look at our SPX trade that we did this week. All right. So at the beginning of the week on Monday, we had a little bit more shaky marketplace where we were at. Market has now came back and has been strong, but we did a put calendar spread. And we would have gotten out of the trade probably as soon as Tuesday. Like, we put that trade on. That trade was profitable almost instantly. And we talked about that on Wednesday's show, that we probably would have got out of the trade. But now the market has came back. And so now we're up towards all-time highs. When we put this last paper trade on, the market was at 51.33. Grab a little drink. The market was at 51.33 in the SPX, and now we're at 51.63. So we got just 1 day's worth of trading, and we sold the 50.90 put. That was trading around $21. And then we have the expiration that goes out to the 15th, 1 week further. And we did the same put. Okay, so let's look at the one that's expiring here. So we're talking about this expiration date, and we're talking about the 15th expiration date, which would be that Friday. And we were in the SPXW, not the SPX. So this is the one that we're going to focus on. So we're here, and let's see what this is trading for. SPX 50.90 put option. All right. So right now that put option is 20 by 25 cents. So the market's really ran out on it. When we put it on, it was a $21 put option. Now there's only 20 cents left that's in that portfolio. This should have a lot more value left in it. Let's look at the March 15th expiration and see what we got left in that. Yeah, we still got $12 in this one. Okay, so interesting enough, yeah, we put that on for $11. So because we've had, even though the market's gone against us, and I actually didn't expect this. I don't know if I didn't expect it, but we are actually still up on this portfolio. We sold that that shorter term option contract, and we bought a lot more expensive longer term option contract. When we put that trade on, the market was at $11. Now, SPX option contracts hold their time premium, and I've mentioned this many times on the show, all the way up until like Wednesday. Then you get some decent rate of decay, and then Thursday, and then Friday, obviously, all the premium has to come out. And so if you're looking at our scenario here, you're seeing that a lot of that time premium is coming out of that option contract, right? So that was a $21 option, and now it's a 20-cent option. If we look at the 1 week option contract here, we now, in that instance, that was, I don't have the number in front of me because I only have the one grid, but I think it was $35. Oh, it would have been $11 more. So that would make sense. It was about a $33 option contract, and now that's trading for $13. So this has held up a lot more than the shorter term option contract, obviously. And because of that, we can actually sell this for a decent profit, $13.43. So it shows you the power of time decay. If the market came down and went against us really hard, we would have had to get out. We would have had to manage our trade. But in this scenario, and I want to make sure I got the right trade, 308 and 315, 13 cents. Okay, so it's now trading. If we flip this around, yeah, we'd be down on this trade. So this would be a buy and this would be a sell. and it would be a 13-cent net debit. So in this instance, we would be down $2.25 on the trade. So if we flip the script and we actually were closing this out, this would be a buy to close and this would be a sell to close. We would be trading for $13 at this point in time. We would be down $2 on that trade. Okay, now you think about that, you put this trade on, the market has gone 30 points against you. We had an opportunity to get out at a profit. We still need the market to go down in that instance. But this shows you the power of a calendar spread, how you're not going to hit a home run in it, but the risks are fairly low. We still have a week remaining until this expiration. So one thing that we could do if we wanted to adjust this trade is we could go back to the March expiration. We have our contract in here that we were short. Now we are buying that, and it's showing that it's green. So you would buy that put to close, and you could come up, we've got the market at 160. We have the 590s that are our long contract that we have sold open on the March expiration. So if you wanted to roll this up and give yourself a little bit more premium, we can do that on this trade. We will have a requirement to do that. We will be adding some risk to the trade. If we stay in this expiration, I don't know how much risk we'd want to add. It'd be a real tough trade, but you'd be looking at somewhere around the 51.20. Now, I'm not saying that we would do this trade. We would have already been out of it. But this is how I would adjust the trade if I was looking at it. You would have had to do it a little sooner because you're not getting much premium anymore. But one of the adjustments that you could do is you could take this option contract and you could roll it up in that same expiration. The only way you're going to get anything that's worth doing is you're going to have to add a requirement in. So you would be buying that to close, and we're going to look at this option contract, and we'd be selling this to open. Okay, so our long option contract is that one. That would be removed. This would be the adjustment, but right now that would put in a 30-point margin requirement on your 1-by-1 spread that you have on your long calendar, and I don't think I would want to do that. But this would be an adjustment you could make a little sooner, where maybe you could have sold the 51.05s for $1 and got a little bit better adjustment on that trade. So in here, you're only looking at an 80-cent net credit. So this isn't the adjustment that I would want to do on this trade. Now, if you fell asleep and you didn't get out of the trade, here's the second adjustment is you can stay at that same strike if you would like, and let's remove this option contract, and we will look at this expiration, and we'll stay at that strike. Let's see what we can get for the 50.90. See, we can still get $14.70 for that underlying stock. So if you wanted to, you could roll all the way out to here and sell a little bit different option contract, like the 50.95, and roll into a short spread that way. That would put in a few dollars, bring in $15, and you'd be in a short spread from 50.95 to 50.90. Or you could go a little bit shorter. So we got so many different options to choose from. I think in this instance, let's keep it a time spread. And let's look at March 13th is the Wednesday. We could do the 12th. Let's look at the 13th. That's 5 days. And once again, we'd be buying this put back for about, it looks like right now, 38 cents. And this is $11 to do this, or we could even stay at that same expiration, or we could go below it and bring in this amount of capital. Okay, let's do this one. So here's the one that I'm going to look at, and this would be a more enticing roll to me. I'm going to sell this one for $11. Okay, so we put on this trade. Let's walk through the scenario. we put on this trade, and I'm going to make sure there's no questions at this point in time. No, it doesn't look like we did. Okay. So, oh yeah, I do see one. Okay. Let's put up can we put up the question from Wayne? Okay, so with Wayne, then I'm going to walk through the scenario in the SPX. I'm doing 0 DTE, SPX, iron condors, and taking them to expiration. It's been working, but if my position is at break even, can I close out my position in the last hour and void max loss? Will there be buyers? Okay, so in other words, you're asking about the liquidity of the market, Wayne. And so you're putting position on 0 DTE, and I'm assuming that you're literally just trading them for one day. So you put them on in the morning, you're going to take them off at the morning on the open, you're going to take them off on the close. And the question is, if I am at break even, if I put that trade on and the market moves against me fairly quickly at any point in time, will there be buyers on those option contracts? Right now, the 0 DTE, the volume has been amazing. So they are leading the markets. Part of the reason why a lot of the exchanges are setting records in volumes are because of the 0 DTE. So yes, in the SPX in particular, there are usually buyers. Now, one of the biggest things about the 0 DTE in the SPX is you have to kind of fish for the buyers because you're going to have fairly wide bid-ask spreads. And that is an issue, but going at the midpoint is usually worked out pretty well for me. It's not as if you're in the SPY and you're doing the 0 DTE, it's a little bit more transparent exactly where you're going to get out at. But in the SPX, and there's a lot of benefits to doing it in the SPX in my mind, especially if you're not in a retirement account. Usually you can feel fairly close to the midpoint. It's never a guarantee. And yes, the volume's there, the liquidity is there. I wouldn't be concerned that I get out if I placed an order in to try to close it fairly close to the midpoint. I'd always give up a nickel or maybe a dime, somewhere in that range. But that's where I would start, is probably a nickel below the mid. All right. So let's go through this scenario on the SPX. Thanks for the question, Wayne. We started by doing a long calendar. We bought the longer term option contract that expired on March 15th. We sold the shorter term contract that expired on March 8th. The strike price was $50.90. We wanted the market to go down. It did. We said we would have closed it. Market has came back. Now we're looking at an adjustment. So if you fell asleep, you are now down on that position. A couple bucks, not bad. It really didn't do too shabby. So you might just close it out. But an alternative, you have a lot of time here because of the daily expirations in the SPX. So we're going to roll into a diagonal spread. We're going to buy to close the 50.90s, which are in this expiration trading for 30 some cents. I'm not going to go there. We're going to be trading for around 30 cents. And then we're going to sell one of the 50.95s. We're going to do this for a net credit to the account of about $11. So in this instance, we have put this entire trade on for $11. We are going to adjust the trade, roll it into a short put spread. We would have a $500 margin requirement because we are going to be short the 30.13s at the 50.95 mark, and we're going to be long the 50.90s. We're going to bring in, well, now it's $11, but basically what we paid for the trade, which was $11 when we put that trade on. We're going to bring in a net credit of $10.75, but we're still going to have risk of $5, and we're going to hope that that marketplace stays above 50.95 by this expiration date. And we still have a long option contract, right? And we're still long the March expiration. So we can still come out and look at this contract, and that's trading for 50.90, and we can still sell that option contract, and that's still trading for $14. So interesting scenario. using what we got to try to adjust this position. This trade I wouldn't have any problems doing right now. I don't want to stick in that March expiration. It just not enough premium and putting on too much risk. I don't mind doing this trade right here if I was still in the trade for the SPX calendar, or i.e. time spread that we first entered. Okay, so I think that we are at time. We're a little bit over time. Appreciate the questions. Please click subscribe, ring the bell if you are in the YouTube platform so you get all the alerts for the next Options Guy TV. Please share it with friends and family. Check us out on the Tradier Hub. We're here every Monday, Wednesday, and Friday at 11 a.m. Eastern Time. On Monday, we're going to look at doing another trade in the SPX. This time, we're going to probably, depending on how the market's open, but look at a long call spread in the SPX. Thanks for coming, everyone. Hopefully see you Monday.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.